Welcome to today's What Moved the Market show. I'm your host Prem. It's Wednesday, February 11th, 2026, and here is everything you need to know as the markets close for today. Indian equities wrapped up a choppy but ultimately muted session, with headline indices moving in a tight band through the day. The Nifty 50 managed to eke out small gains, ending just under the 26,000 mark, up about 0.07% and closing near 25,954. The Sensex, on the other hand, slipped around 0.05% to finish close to 84,234, while Bank Nifty outperformed, adding roughly 0.2% to end a shade above 60,745. The big picture: auto, healthcare and select banking names kept the market's bullish undertone alive, even as heavyweights in information technology and energy capped the upside. Sentiment was best described as cautiously optimistic, with traders unwilling to take big directional bets ahead of key United States jobs data and after a strong run over the past few sessions. On the currency front, the rupee remained soft. As of the latest available data, the dollar-rupee pair hovered around 90.65 to the dollar, not far from record week levels seen in January near 92.29. That gently weaker rupee underpinned export-oriented pockets, but also kept an overhang on oil marketing companies and import-heavy sectors, reinforcing the market's preference for domestically driven stories like autos, hospitals, and select banks. Turning to stock movers, the star of the day on the Nifty was Eicher Motors. The stock rallied more than 6% after the company reported a strong third quarter, with profit growing over 20% year-on-year and healthy revenue expansion, reassuring the street on the premium motorcycle cycle and margin trajectory. Apollo Hospitals also surged, gaining close to 4% after posting a robust jump in quarterly profit and improved operating performance, which supported the broader healthcare and hospital trade. State Bank of India extended its recent momentum, rising over 3% as investors continue to reward better asset quality, solid credit growth, and the broader theme of domestic financials leading this leg of the market. Among mid and small caps, names like Supreme Industries and PCBL stood out with sharp gains, reflecting stock-specific buying post-earnings and the still healthy risk appetite beneath the surface. On the losing side, the drag clearly came from large-cap information technology. Tata Consultancy Services dropped more than 2%, while Infosys and HCL Tech also ended notably lower. After the recent rebound in global tech, worries around spending discipline in traditional software, rising competition from artificial intelligence-driven models, and a slightly softer global macro tone triggered profit taking in these counters. Coal India too slipped close to 2%, with some investors booking gains after its strong run amid mixed cues on global coal prices. Together, the weakness in technology and selectively in energy offset much of the strength seen in autos, healthcare and banks, leaving the indices looking flat even though there was plenty happening under the hood. From a levels perspective, today's intraday action was important for traders. On the Nifty 50, the index reclaimed the psychological 26,000 mark early on, but repeatedly failed to sustain above it, topping out near 26,009 and then slipping back. On the downside, dips towards the 25,900 zone attracted buying interest, very much in line with the immediate support area that many technicians had been watching between about 25,860 and 25,900. The fact that this band held on closing basis keeps the short-term structure positive, with 26,000 to 26,020 now acting as a near-term resistance ceiling. Bank Nifty, meanwhile, respected support zones remarkably well. Intraday lows came in just above the 60,450 to 60,500 area, which had been flagged as the immediate demand pocket, and the index managed to close comfortably above that. On the top side, 60,900 to 61,000 remains the key resistance belt that bulls need to conquer for the next leg higher. For short-term traders, the message is clear. As long as Nifty holds above roughly 25,900 and Bank Nifty stays above 60,500, the bias remains buy on declines rather than sell on rallies. Sector-wise, leadership was again with autos, healthcare and consumer-oriented pockets. Auto and healthcare indices on the cash market gained around 1% or a little more, driven by strong results from Eicher Maruti and the hospital pack. Public sector banks chipped in with steady gains, helped by the improving credit cycle and the belief that domestic growth will remain robust after the Reserve Bank of India's latest policy. On the flip side, the information technology index fell more than 1%, making it the biggest drag of the day, while energy and oil and gas names were also under mild pressure as traders weighed firm crude prices, a soft rupee, and the outlook for global demand. Shifting to commodities, as of the latest available data, crude oil prices internationally are hovering in the high $60s per barrel. Ongoing tension in the Middle East, particularly between the United States and Iran, has kept a geopolitical risk premium embedded in oil, even as concerns about global growth and demand periodically cap rallies. For India, that combination of firm oil and a soft rupee remains a key macro swing factor, especially for upstream and downstream energy names and transport-heavy businesses. On the bullion side, MCX gold futures are trading close to 1,58,000 rupees per 10 grams, down modestly on the day after a sharp run-up, but still higher on the week, while silver on MCX is around 2,52,300 rupees per kilogram and has underperformed, seeing a steeper intraday correction. The sharp moves in precious metals this month, driven by expectations of eventual rate cuts in developed markets and safe haven demand, continue to influence sentiment in jewelry retailers and gold finance companies. In terms of geopolitics and global cues, investors remain focused on two big themes today. First, the upcoming United States jobs report, where any significant downside surprise could stoke fresh worries about global growth, even as it strengthens the case for more rate cuts from the Federal Reserve. Second, simmering tensions in the Middle East and the broader backdrop of rising geopolitical risk, which several global surveys now flag as the single biggest potential driver of volatility in 2026. Asian markets largely held near their recent highs, but there was a clear preference for quality and defensives, and that cautious tone rubbed off on Indian equities as well, keeping high beta pockets like smaller metals and high-growth discretionary names in check, even as domestic macros look solid. Looking ahead to tomorrow's session, the technical setup for the Nifty 50 remains constructive but finely balanced. Immediate support is clustered around 25,900, with deeper support zones between about 25,700 and 25,500. On the upside, a clean break and close above the 26,000 to 26,100 band could open the door for a move towards the next major resistance, around 26,400, over the coming days. Bank Nifty continues to be the relative strength index, holding above 60,500, keeps the path open towards 60,900, and then 61,000 to 61,500. A decisive push from frontline private banks and State Bank of India could allow Bank Nifty to lead any breakout, while a fall back below 60,000 would warn of a deeper consolidation towards 59,500. The key catalysts to watch overnight are the United States data, any fresh headlines on India's trade negotiations, and the trajectory of crude and the rupee. One actionable takeaway from today's trade is to lean on the strength shown by domestic cyclicals while respecting clearly defined index levels. For short-term traders, that can mean looking for staggered buying opportunities in strong sectors like autos, hospitals, and quality banks if Nifty holds above the 25,900 support and Bank Nifty above 60,500, while keeping a tight stop just below those zones. At the same time, it may be prudent to avoid chasing bounces in the information technology pack until prices show evidence of stabilizing after today's sell-off, and to be extra disciplined with position sizing in single stock derivatives, given the evolving SEBI framework around margins and order to trade norms. That's it from this evening's edition of What Moved the Market. If you have questions on specific stocks, sectors, or trading setups, send them in and they might feature in an upcoming show. Stay tuned for tomorrow morning's wrap and send in your questions.